Hi everybody, this is Lara with your end of the week video for US oil for the trading week ending Friday 22nd of November. I'm still expecting overall sideways movement for a couple of weeks or so to complete an Elliott Wave triangle, and when that's done, a downward breakout. Within the sideways movement, I expect that next week price may begin to move into a little B wave, so it could be a sharp, quick downward movement, or it could be a quite time-consuming sideways choppy consolidation within the larger consolidation. When that's done, the final upward swing should end to complete the Elliott Wave triangle, so it's got probably another 2 or 3 weeks or so to go. My main wave count is still bearish. This is preferred because it has more support from classic technical analysis, particularly at the monthly chart level. I'll get into that after I've gone through 2 Elliott Wave counts for you. I have this main Elliott Wave count, and then I have an alternate, which is bullish. This Elliott Wave count expects that a bear market for oil continues, and this Elliott Wave structure is a double zigzag in a second wave position at supercycle degree. That's a reasonably common structure for a second wave. The first zigzag in the double is complete down here, and it looks like a really obvious 3-wave structure. It's labelled cycle wave W. The double is joined by a 3 in the opposite direction labelled X, and here begins the second zigzag in the double labelled A, B, C at primary degree. An Elliott Wave triangle may be unfolding in a B wave position, and it may be within the final little 5th subwave, wave E of the triangle. Wave B, within this zigzag of cycle Y, may not move beyond the start of A above the invalidation point. Let's take a look now at the weekly chart for this wave count. We're going to see from this low here, this point here, cycle wave X is a zigzag. Here begins cycle wave Y, labelled A, B, C. I'm labelling this as a triangle at the weekly chart level, but I've got 2 daily charts looking at this structure in 2 different ways. Importantly, from this low to this high, when I look at this at lower time frames, at the daily chart level particularly, it's really easy to see this upward wave as a 3-wave zigzag, and really quite difficult to see it as a 5. My bearish wave count sees this as a single zigzag, and that has the best fit. Let's take a look now at this triangle for primary wave B. We're going to look from this point here. Here's the end of a zigzag for intermediate A, a double zigzag for intermediate B, a single zigzag for intermediate C and D, and now E unfolding. Elliott Wave triangles have 5 subwaves. They're analogous to classic triangles, but there are some important differences. The rules for Elliott Wave triangles are really restrictive, and they are always continuation patterns. For this example, let's just really quickly go back to the weekly chart. The angle of entry was downward, so the angle of exit should be downward because the triangle is a continuation pattern. 4 of the 5 subwaves of an Elliott Wave triangle must be zigzag or zigzag multiples, with only 1 subwave allowed to be a multiple, and here intermediate wave D fits best as a multiple. That's important because it tells us that intermediate E should be a single corrective structure, most likely a zigzag, and so far it may be subdividing 5, 3, 5. Minor wave A within this zigzag may now be a complete leading expanding diagonal. Within a leading diagonal, subwaves 2 and 4 may only subdivide as zigzags. Subwaves 1, 3 and 5 are most commonly zigzags, but they may also be impulses within a leading diagonal. And so that's why you see this 3rd wave labelled as a zigzag. Even though it's a 3rd wave, that's the only time a 3rd wave is going to be anything other than an impulse, when it's within a diagonal. This diagonal may be expanding. The 3rd wave is longer than the 1st, the 5th is longer than the 3rd, and the 4th is longer than the 2nd, and the trend lines are diverging. The 5th wave has now slightly passed equality in length, and so all the rules regarding this structure are now met. We could be seeing a trend change into either a sharp pullback or a sideways consolidation for minor wave B, which may not move beyond the start of A, below the invalidation point. This invalidation point is absolute. A new low by a fraction of a cent on a tick chart is enough to invalidate this Elliott Wave triangle at this stage. It's also possible that minuet C might not be over at Friday's high and it could continue a little bit higher. When minor wave B arrives, it could subdivide as any one of more than 23 Elliott wave structures. B waves exhibit the greatest variety in structure and price behavior. It's essential to be quite flexible when a B wave is expected. They are analogous to quick sharp bounces or pullbacks or sideways consolidations. Minor wave B could even be as long lasting as about 2 weeks. It could be very choppy and overlapping, or it could be over in just a few days as a quick sharp pullback within this bigger context of an upward swing. When minor B is done, then minor C should move higher and should make a new high beyond the end of A to avoid a truncation, and would most likely take intermediate wave E up to fall somewhat short of the AC trend line. That's the most common point for E waves of Elliott wave triangles to end. It may not move beyond the end of C above this invalidation point. Again, a fraction of a cent on a tick chart would be enough to invalidate this Elliott wave triangle for primary wave B. In classic analysis terms, an upward swing is expected to continue. It'll be choppy and overlapping. That's normal behavior for price when it's within a big consolidation. Within the upward swing, a downward or sideways movement, and then the upward swing to continue and to fall short of prior resistance. If that Elliott wave triangle is invalidated, let's just go back. This upward movement here is seen as a zigzag for this chart and this chart, but in the second chart now it's labelled as the first structure in a possible double combination. Too many times over the years I've expected an Elliott wave triangle was continuing only for the structure to be invalidated, and it turns out to be something else, and the something else is almost always a combination. So I've learned the hard way over the years. I should always have an alternate wave count when I think an Elliott wave triangle is unfolding, and I should always be considering a combination. Here I'm considering a combination for primary B. The first structure in a possible double may be a complete zigzag over up here labelled intermediate wave W. The double may be joined by a complete 3 in the opposite direction labelled X, and it subdivides as a zigzag. And the second structure in the combination may be continuing as a flat correction labelled intermediate wave Y, and one zigzag and one flat is by a very wide margin the most common two structures in a double combination. Let's turn our attention now to this rather complicated flat correction for intermediate Y. Flat correction subdivide 3, 3, 5, and within it minor B may be incomplete. It needs to retrace a minimum 90% the length of A at 50. Well, it's already done that, but it needs to complete now as a double combination. I'm not labelling it over here because to label minor B over here it would be a flat 3, 3, 5. It would be a running flat because C would not have moved below A, so I'm not going to label minor B over there because I don't want to rely on a wave count with a very rare structure like a running flat that is not here within the context of a running flat. Running flats have C waves that are truncated, and they really should only be considered in the larger context of a very strong trend, and this is not a trend, this is a sideways consolidation. And so I'm considering that minor B is incomplete, and I'm labelling it as a double combination. W, X, Y. W is a zigzag and Y is a flat correction to subdivide 3, 3, 5. The B wave within the flat still needs to reach up to a minimum 90% the length of the A wave at this price point or above. When the B wave is done, a C wave down needs to take price below the end of the A wave to avoid a truncation, and then that would complete minute wave Y, a flat correction, within a combination for minor wave B. This wave count is analogous again to a sideways consolidation, but the swings of up to resistance and down to support are expected to be stronger and move further than that first triangle wave count. When minor wave B is complete, this wave count would then need a 5 wave structure up for minor C to move beyond the end of A and most likely to take intermediate Y up to end about the same level as intermediate W to achieve its purpose of taking up time and moving price sideways. At the monthly chart level, this is my alternate wave count. What if the bear market for oil was over back here? It does subdivide as a really nice zigzag. It looks like a pretty obvious three-wave structure. And if that's the end of the bear market, this is the start of a bull market, and I have a target for a third wave up for you. If this is the start of a bull market, then the first wave up needs to complete as a 5-wave structure. That's possible. In my experience and opinion, this upward movement has a better fit as a 3 than a 5, but it will subdivide either way, so let's consider both possibilities. This could be a completed zigzag. I'm labelling a second wave at cycle degree. It's ended pretty close to 0.618 Fibonacci ratio of cycle 1. And if that's where a second wave ends, that means that's where a third wave begins. And the biggest problem for this wave count is this movement here. At lower time frames, particularly daily, it's really difficult to see this upward movement as a 5-wave structure, and you have to do that for this wave count, or for the way I've labelled it anyway. The target for cycle 3 is for it to reach a common Fibonacci ratio of 1.618, the length of cycle 1. Within cycle 3, no second wave correction may move beyond the start of its first wave. Let's take a look at the weekly chart now, with a high for cycle 1 and its beginning. Here's its beginning, here's its end, here's cycle 2. At the weekly chart level, this does look like a 3-wave structure. This is the only part of this wave count that has a better look than the main wave count. This is really problematic at lower time frames, but for this wave count, I have to see it as a 5-wave structure. And now attention turns to the structure of primary wave 2. I can't label this as a second wave correction with the sole structure as a triangle, because triangles do not unfold as the sole corrective structure in a second wave position, but they can unfold as part of a combination within a second wave. So that's how I'm considering this. So it's a different way of considering the triangle. So we've got an alternate idea here. Primary 2 may not move beyond the start of primary 1 below the invalidation point. Let's take a look at the daily chart now, with a high for primary 1. There's this point up here. Here's a possible combination for primary 2, zigzag, X, triangle, subdividing A, B, C, D, E, D to complete. And so this triangle for intermediate Y may be either a running barrier triangle or a running contracting triangle. There's a little difference in one of the rules between them. A contracting triangle is the most common type. Within a contracting triangle, D may not move beyond the end of B above the invalidation point. A barrier triangle is not rare, it's just not as common as a contracting triangle. I've seen a fair few of them over the years. Within a barrier triangle, D should end about the same level as B, as long as the BD trend line looks essentially flat to the eye. A barrier triangle will remain valid, and what that means in practice, in reality, is D can move slightly beyond B, and a barrier triangle for this count would remain a valid wave count. That's the only Elliott wave rule that's not absolute. It involves a small area of subjectivity, which is nice because that means all the other Elliott wave rules are absolute, and you know, even by a fraction of a cent on a tick chart, as soon as one count's invalidated, and then you shift attention to the next probable wave count. It's the best way to use Elliott wave. For both the contracting and barrier triangle type, E may not move beyond the end of C below this invalidation point. So this wave count requires sideways, choppy, overlapping movement to remain, can possibly slightly break above this resistance, but certainly not to break below support for the structure to complete. More sideways movement for another 2, 3, 4, maybe even 5 weeks. These triangles can be quite time consuming and test our patience. I think that's actually their purpose. When this is done, this wave count expects an upward breakout because it's a bullish wave count, but it doesn't have as much support from classic technical analysis, and let's take a look at that now, particularly the monthly chart. at the monthly chart level. From this high up here, the downward movement started with a strong bearish engulfing candlestick pattern. It also had a long upper wick, and it had some push from volume, actively pushing price lower. This is a good strong candlestick reversal pattern. And then we had a good strong fall, downward movement for another couple of months. The middle month, a good strong push from volume. The last month, some decline and a bit of a long lower wick, so we were expecting a bounce. We've got it, but this bounce has some weakness within it. It had some lighter volume, but also importantly, it had declining ATR. The bulls were able to push price a smaller and smaller amount each month compared to the first month. And then we had another really strong bearish engulfing candlestick pattern with a very strong push from volume, actively pushing price lower. This movement and this month here strongly support the main Elliott wave count, and this is one of the pieces of evidence that I'm relying upon the most in making that decision about which wave count looks more likely at this stage. Also in terms of Elliott wave, the subdivisions have a better fit. We're now in a sideways churning movement, some consolidation, so not really too much can be read from this, although we can say that volume is more active on downward months. There's more strength from volume pushing price lower when price is in a downward movement. This last month is incomplete, and so I can't make any judgment on November until it's complete. RSI is perfectly, or almost perfectly, in neutral territory. There is plenty of room for price to rise or fall. MACD is bearish but not fully so. It's still not fully below the zero line. On balance, volume is constrained. Now, if you have a more bullish outlook for oil, here is one piece of evidence you could use to support that view. Here, on balance, volume made new highs, but price hasn't made corresponding highs. We read on balance volume as a leading indicator. Where it goes, price often follows, not always. This divergence, I've noted over the years, just doesn't always work. But while it's here, we give it some attention, and it does support a more bullish view. And that's one reason why I do have that bullish alternate wave count. We can use those clear price points with the Elliott wave structures to tell us when one count's invalidated and we move attention to the next. At the weekly chart level also, there's some reasonably good support here for a more bearish outlook. As price falls, volume pushes price lower and ATR increases. The bears are able on this weekly chart to push price a greater and greater distance, and they are doing it with strong support from volume pushing price lower. There is strength in that downward movement, and then when price rises, it does so initially with declining volume, but with some support from volume at the end. But throughout the whole rise, ATR quite strongly declines. Then again, as price falls, some support from volume. This downward week here is actually a downward week, even though it closes green, and ATR increasing. Then we move into a sideways churn, and ATR flattening off, increasing here, as again price was falling, again support for a more bearish outlook. Now price is rising, and it's doing so with some difficulty. There is a long bullish wick on this last weekly candlestick. I would expect possibly some more upward movement after that next week, and a bit of push from volume pushing price lower. It's a strong outside week that's closed red, so the balance of volume was downward. Well, it's essentially flat. Sorry, the balance of volume was upward, but it is a red candlestick, so that's a rather difficult week to read. I'll give the most weight to the bullish long lower wick and look out for a little bit more upward movement next week. That does contradict my short-term picture for my main Elliott wave count. But as I said, it is possible that that fifth wave of that diagonal could continue a bit higher. So maybe I'm premature with my downward arrow there on that chart. At this time frame, it's pretty obvious that price is consolidating. ADX is declining. The DX lines are whipsawing. Price is consolidating with resistance about 63, 64, support about 52 and a little bit below. We've got some overshoots of that too. On balance volume, the last signal it gave was bullish. That was a couple of weeks ago, and we're overall getting a little bit of upward movement. RSI is neutral at this time frame as well, plenty of room for price to fall or rise, and stochastics almost perfectly in neutral territory. What about the daily chart? This upward movement is choppy and overlapping. That is just absolutely typical of price behaviour within a larger context of a big consolidation. For the most recent days, some push from volume to push price higher. But on the second day here of upward movement, Thursday, as price moved higher, again a decline in volume. So not necessarily sustainable. If we are going to get more upward movement next week, it might not actually be by that much. And that fits the Elliott Wave count just fine. ADX is declining. It's at really low levels. The DX lines are whipsawing. Very obvious at this time frame as well that price is consolidating. ATR is declining as price moves sideways, and on balance volume at this time frame is well constrained. If it can break above resistance or below support next week, then for the short term I'd expect price to move in the same direction. RSI at this time frame also really well within neutral territory. Stochastics returning to overbought, and when price is consolidating, this can provide resistance and halt a rise in price. So there's not a lot of room above before price reaches higher to resistance, and stochastics is already telling us that the upward swing may be done. So we may see some downward reaction in here to relieve that condition before it can continue on up to resistance. So overall, not much change. Price is consolidating, choppy, overlapping sideways movement. I don't think it's done yet. I think it's got a few more weeks. And when it's done, I am expecting a downward breakout. That's all from me this week with your oil analysis. I hope all our members are having an awesome weekend.